Hello, our beloved viewers and learners. It is Teacher Eria from Wuna Education Services. In today's episode, I'm going to be taking you through the format of preparing a trading profit and loss account. It is also called an income statement. In my previous videos, I told you I drafted for you the preparation of a trading account and the preparation of a profit and loss account, and the combination of a trading account and a profit and loss account gives us an income statement or a trading profit and loss account. Now, in today's episode, I'm going to be taking you through the format of preparing a trading profit and loss account or an income statement. Now, when you're preparing any trading account or any financial statement, we always begin by coming up with the business name, the name of the account or the statement, and the period in which the transactions took place. Now, I'm going to be teaching you the format of a trading profit and loss account or an income statement. And we should begin with the name of the business. Choose any business name, the name of the account, and this instance we are dealing with a trading profit and loss account. It's also called an income statement. Then for the period ended, we write it on 3 lines. The first line is for the name of the business. The second line is for the name of the account or the statement, that is a trading profit and loss account. Then the third line is for the period for which the transactions took place. And this is our format. In an income statement, when we are preparing an income statement, the first we draw our format we draw 4 columns. The first column, you put details here, you put UGX here. UGX, that is our Ugandan currency, that is UGX. So it is 4 columns. So our first entry when we are posting or we are drafting an income statement or trading profit and loss account are the sales. So we post our sales here, and the error is posted in the second column. Then we all know that when we sell goods to customers, as I discussed previously in the trading account, when we sell goods to the customer, we expect some goods to return back to the business because maybe some goods have been sold to a customer without it's not their order, it is out of their order. Maybe the goods are expired. The goods you placed a long order. Let's say you own a boutique and then someone placed shoes of size 30 and for you delivered those of 40, meaning that customer has returned those goods you sold to him back to the business, and they are called sales returns. So we less sales minus sales returns. So that's goods you sold to customers and what customers return to the business or the premises is what we call the sales returns. And when you less sales minus sales returns, we get what we call net sales. And net sales are always posted in the third column. So after we lessing the sales minus sales returns or returns inwards, those goods returned by customers, we get the net sales. Then after we getting our net sales, we less cost of sales. Cost of sales means those expenses you've incurred in purchasing commodities for sale. In production, they are called costs of production. Those expenses you incur in producing a product. So the first entry we post under when we are finding the cost of sales is the opening stock. Opening stock means the inventory at the beginning of the year. And note this, that opening stock is always the closing stock of the previous year. This is 2025. The opening stock of 2025 was the closing stock of 2024. So business people, when the year has ended and some unsold goods have remained, they won't go and throw them. They have to carry them in the next year so that they can also be sold. So those goods carried on in the next year are called, or those goods at the beginning of the year are called opening stock. They are called opening stock. Then we all know that opening stock is not always enough to satisfy the customer's needs. So what sellers do, or what those business people do, they go and add purchases to supplement on the opening stock, because it is just left over of the products in the previous year. So they go and make more purchases. That's why we add purchases on opening stock. Then purchases are always posted in the first column. They are always posted in the first column. So purchases, we add purchases on the opening stock and they are posted in the first column. They are posted in the first column because they have direct expenses on them. When you go to purchase goods for maybe sale in your business, you have some expenses you're going to make besides purchasing the goods. Talk about carriage inwards. Carriage inwards means those transportation costs you incur for those trucks or those vans that are going to transport your goods to your premises. So those are carriage inwards. The transportation costs you incur in transporting your goods to your premises are called carriage inwards. That's why you always add the carriage inwards, because it is an expense you're going to incur. It is a direct expense on purchase, so you add it here also. Then people always shop heavier products, meaning you'll need people to offload and load for you those products. Then you're going to pay those people some wages or some money, and that money is called wages. Any reward or payment to unskilled labor is called a wage. That's why we add wages here. So purchases plus carriage inwards plus wages, we get the total purchases here. Then we know that in some instances also, you can place an order and goods delivered to your premises, but find out that what they have delivered is not what you ordered. Some of the products you ordered are not the ones that have been delivered. So you'll have to take back those goods to those premises you bought them from. So that's why we deduct the total purchases. We say less purchase returns. So these are total purchases. Then we say less purchase returns, and we get the net purchases, and we get the net purchases, and we post the net purchases in the second column. Now, all what we are aiming at in an income statement is getting the net profit. And we said when you're preparing an income statement, it is a combination of a trading account and profit and loss account. So we shall be finding gross profit and gross loss. So we have opening stock, we have net purchases. You compare these two by adding them. When you add opening stock and you add opening stock plus net purchases, what you get is goods available for sale. Opening stock plus net purchases, we get what we call goods available for sale. Goods available for sale. We have goods available for sale, and our aim is getting gross profit. So we can say goods available for sale less closing stock. Closing stock is that remaining stock in the business unsold at the end of the year. This is 2025. When the year is subsiding or it is ending, those stock left unsold is called the closing stock. The business is closing and that is ending, but some stock has remained unsold. That stock is called closing stock. So for us to get the cost of sales, we shall say goods available for sale. It is posted here, and then less cost of sales. For us to get the cost of, we deduct goods available for sale, less closing stock, and then we get cost of sales, and we post it here. We post the cost of sales here. Our aim is getting net profit or net loss. Now when you come and compare these two, we have net sales, and then we have cost of sales here. You come and compare these two items. We have net sales and cost of sales. When you add net sales and cost of sales, when you compare these two, it gives you gross profit or gross loss. When the business has more net sales and has less cost of sales, meaning the business has incurred a gross profit, But when the business has cost of sales being more than the net sales, meaning the business has incurred a gross loss. So you come and compare these to come and compare net sales and cost of sales. When cost of net sales is greater than the cost of sales, meaning it is a gross profit. But when the cost of sales is greater than cost, not net sales, it is a gross loss. So after you obtaining the gross loss, we are done. That is the trading account. Now we are going to the profit and loss account from what we have been preparing previously, if you've been watching those formats. Then after we getting the gross profit or gross loss, we add supplementary incomes. Supplementary incomes means those additional incomes the business earns from its operations. And examples here, we have rent income. So you come and post them in the second column here. Then we have commission received. Maybe a business received commission from some bank or some microfinance institution, and then you also add it here. Then you get the total supplementary incomes. The formula of getting gross income is gross profit or gross loss plus supplementary incomes. So we have our total supplementary income here. It is here. So we add gross profit or gross loss plus supplementary incomes to get the gross income. So we have our gross income here. You post it in the last column here. Then after we getting our gross income, we less the operating expenses. You come and less the operating expenses here. So less operating expenses. Operating expenses are also called indirect expenses, like those expenses made by the business. Let's say purchases, payments, like those day-to-day expenses like telephone charges, some example here. So you come and add them here, and then get the total operating expenses and less them from the gross income. The formula of getting net profit is gross profit or gross loss plus supplementary income minus or less operating expenses, and then you get the net profit. It can also be net profit or net loss equals to gross income then less operating expenses. That is it. So we get our net profit by adding the gross profit or gross loss plus supplementary incomes, then we less the operating expenses, or it is gross income less operating expenses, and we get our net profit here, and then we get our net profit here. So that is the format of preparation of a trading profit and loss account or an income statement. Remember, here we are finding the gross profit of the business. We are finding the gross profit of the business. That is the format of preparing a trading profit and loss account. It is also called an income statement. Our aim here is getting the net profit or net loss of the business. I remain teacher Eria from Wuna Education Services. Thank you for watching and listening. Let's meet in the next episode.